Good morning, ladies and gentlemen. I see a whole bunch of new people just came in the room. Welcome to Are We in the Midst of a Commodity Supercycle with Carley Garner. She's here. We're going to get started in about 1 minute. Again, I hope you all have been enjoying the virtual expo, and we'll get started momentarily. Carley, are you there?
Yes, I'm here.
Great. I'm going to go ahead and stop sharing my screen so you can get yours all set up.
All right.
Okay, everything looks great, Carley. I'm going to go ahead and offer you a proper introduction, and then the floor will be yours.
Sounds good. Thank you.
You're welcome. Ladies and gentlemen, please welcome Carley Garner, an experienced futures and options broker with Carley Trading, a division of Zaner Financial Services in Las Vegas, Nevada. Her commodity market analysis is often referenced on Jim Cramer's Mad Money on CNBC, and she is a regular guest on Bloomberg Television's Options Insight segment with Abigail Doolittle. Ms. Garner is an award-winning commodity futures and options trading book author, with books including Trading Commodity Options with Creativity, Higher Probability Commodity Trading, a trader's first book on commodities, where there are 3 editions, and others. Carley, it's great to have you with us today.
Thanks, Chantel. It's good to be here, and I appreciate everybody coming out and joining us today, especially during the trading day. We're going to talk about, obviously, commodity super cycles. Are we in one? Are we not? Is this the beginning or is this the end? Once again, my name is Carley Garner. If you have any questions, comments, or concerns about anything that we talk about today, this is where you can reach me. decarleytrading.com is our web address. You can shoot me an email or give me a call. If you're on social media, we'd love to see you there as well. We're on Facebook, Twitter, Instagram, and YouTube. If you search for DeCarley Trading, you should find us pretty easily. There is a substantial risk of loss in trading futures and options. It's not suitable for everybody. In fact, it's not suitable for most people. It is a far different experience than investing in stocks or bonds, something that creates cash inflow with dividends or interest payments. This is pure speculation. And I know a lot of people have in their mind that they want to be long commodities because of inflation, and they want to hedge their inflation risk. And while that probably was a really, really good idea about a year ago, I'm thinking it's probably too late to employ that type of a strategy in today's markets. And we're going to go through some of the primary commodity markets, crude oil, copper, those sorts of things, and kind of just show you what I'm talking about. Commodities are not a buy and hold investment like stocks might be. Over time, stocks almost always go up. I mean, there's been a few periods of time, decades in some cases, that stocks go sideways or don't produce gains, but during that time they're producing income. Commodities don't do that. Commodities generally don't always go up. Even during times of inflation, you might be surprised to see that commodities generally trade sideways. And more importantly, commodity rallies are often temporary. This is a monthly chart of crude oil. And despite inflation that comes and goes, whether it's high or low, and by the way, inflation always exists in some form, or at least almost always, yet commodities generally trade sideways. Crude oil is most comfortable between $30 a barrel and $85 a barrel. I mean, that's a big range. Obviously, there's some volatility there, but you can see from this chart that dates back to 2002, it's not as simple as just buying and holding commodities and hoping for the best. That would have worked from 2002 to 2007, 2008, but beyond that, it has not worked. And prior to that, it didn't work either. So again, commodities are not a buy and hold investment. They're more of a trading vehicle or a diversification vehicle. And the reason for this is when commodities become expensive, supply always comes. It doesn't matter what scenario, which commodity we're talking about, it always comes. It's a matter of when, not if. I mean, it's not difficult to imagine with high commodity prices, producers try to capitalize on that by bringing supply to the market. When commodity prices are cheap, they shut their supply spigots down and withhold supply from the market. And that's exactly what we see in things like crude oil constantly over time. It wasn't that long ago that we were swimming in crude oil, and now it seems like we can't get enough of it. So commodities are a boom and bust type of market. They're also a feast or famine type of market. In my opinion, we've probably seen the reflation trade capitulate. And when I say reflation trade, it's basically the practice of buying stocks, buying risk assets, selling treasuries. In my opinion, that story has come and capitulated, and it's probably on its way out the door. Of course, there's still the fundamental backdrop of fiscal stimulus, the Fed, quote unquote, printing money, soaring expectations of inflation. But expectations of inflation at this particular time are at about the highest we've ever seen in the history of those types of readings. And if the one thing I've learned throughout my years in the markets is if everybody is expecting the same thing, we generally see the exact opposite unfold over time. And it's a pretty simple explanation for that. If everybody thinks inflation is high, they've probably already sold their treasuries. They've probably already gone long in commodities or whatever assets they think are going to hedge inflation. And so all of that's probably already priced in. I can tell you that based on my research and some of the things I've been looking at, the allocation towards stocks is near an all-time high, and the allocation to away from treasuries is at an all-time low. So in other words, people are holding more stocks and less treasuries in their average portfolio than we've ever seen before. Now, can this continue in the next couple of months? Sure, it can. But the reality is at some point that's going to reverse itself. Again, if everybody's already thinking one thing, we generally see the opposite. And in the case of commodities, I think there's some self-fulfilling prophecy going on. Everybody's been told sell treasuries, buy commodities. That's how you hedge inflation. And so that's exactly what they did. A lot of money came into commodities earlier in 2021. And to be honest, a lot of that money ignored fundamentals. They were buying corn at $7. They were buying, prices that probably fundamentally couldn't be sustained. And over time, we realized, yeah, absolutely, it was not sustainable. We'll look at some charts in a minute just to kind of paint a picture of this. But when we talk about supercycles is a way of describing sticky inflation. Now, there's two types of inflation, so I want to make sure we're talking about the same thing here. I'm not talking necessarily about inflation at the grocery store or maybe even at the gas pump. Inflation to the retail consumer sticks around for a lot longer than it does in commodity markets. In other words, crude oil could drop from $75 to $50 in the next month, but prices at the pump are going to take probably 6 months or longer to dribble lower. That's just how it happens. Ironically, on the opposite side, when commodities are going higher, the retail prices go higher very quickly, but they're very slowly to retract. And a supercycle is categorized as decades, not months or even a year or two. So keep that in mind. Now, there's a few things that I believe are antagonistic to a supercycle, meaning commodities, not necessarily retail prices, but commodities staying higher for long periods of time, such as a decade. And the first being the US dollar. The dollar is stronger now than it was during the commodity rally from 2007 to 2012, which was a doozy. At that time, the dollar index was hovering from 70 to 90. We're currently seeing the dollar index range from 90 to 105. So a higher dollar automatically keeps the upside potential in commodities capped. In other words, it tapers potential for rampant speculative rallies. Now, of course, if I'm wrong about this and the dollar breaks below 89, that literally opens the door for a true commodity supercycle. But I do not think that's possible, or I'm going to retract that word. I shouldn't have said possible. I do not think it's probable. Anything is possible. That's something else I've learned in commodities. You can never say never. Most people forget, but the dollar plays a really big role in how the commodity markets are behaving. For instance, this is a monthly chart of the dollar index versus oil. And you can see that, by the way, oil's in black and the dollar index is in green. You can see as oil spikes higher, the dollar generally puts in a low and vice versa. And this is again because when the dollar is cheaper, oil is generally more expensive. When the dollar is expensive, oil is generally cheaper. So again, if the US dollar continues to move higher, that's going to put downward pressure on crude oil and vice versa. Now, the interesting thing is in the last couple of weeks, that relationship has kind of been ignored by the markets. The dollar and oil have been moving higher, or at least the dollar's been moving higher and oil hasn't been reacting. So the oil market's ignoring the dollar for now, but at some point that's going to have to revert itself. So with that in mind, I think that the crude oil rally is probably a little overheated here, and I'm going to show you a chart to show you why. So this is just a chart explaining, again, the last commodity boom that saw the dollar index from 90 to 75, and currently we're around 90 to 105. So the dollar is a lot more expensive now than it was 10, 20 years ago, which will, that alone, all else being equal, prevent commodities from getting really wild on the upside, or at least it should. Another thing that I think could hold the commodity rallies back is the futures markets are more liquid than they were 10, 20 years ago. They trade longer hours, and they're more accessible to both speculators and hedgers. So in other words, it's a more civilized market than it was in the 70s or early 2000s. That doesn't mean that we can't get some crazy volatility, because obviously we have seen just that in 2021. We've seen a lot of that. But at the same time, it is a little more civilized than it was back in the 70s. And especially if we're looking specifically at wheat, in 2008, wheat futures traded in excess of $13 per bushel. Right now it's about $8.50-ish, which is the highest it's been in years. But it's still a far cry from the $13 that we saw in 2008. That 2008 move in wheat was a very odd scenario. It was at a time where the markets just began trading overnight. And so there was an overnight session, but it was extremely illiquid. And what happened is a lot of the price movement in that rally occurred in the overnight session on illiquid trading. So it didn't take a lot to push prices around. There's a lot of big short squeezing going on. In fact, it almost put one big brokerage completely out of business. And we're talking about a time where people didn't have access to live pricing like we do now. We can see almost 24 hours a day exactly where a commodity is priced, and then we can make, hopefully, rational decisions based on that information. In the early 2000s, people had to call and ask their broker where the price was, or they had to call a quote machine, which cost them a few dollars every time they called. So the information just wasn't there. And if you don't know what's going on and you suddenly find out the market's going against you, it enhances the panic and the emotions that you might feel. And it just makes everything a little more chaotic than it would be now with information flowing. So again, investors and traders have more access to timely information. And in my opinion, it takes a little bit, not all, but a little bit of the emotion out of it. And it calms the markets down just a tad. So that alone, in theory, should prevent some weird things like $13 wheat from happening. You might remember at the same time we saw crude oil get to $150 a barrel. I really don't think that's in the cards. I'll show you a chart in a minute as to why I don't think that. Also, improved technology has created a far more efficient climate for farmers, mining operations, and energy extraction, aka fracking. Fracking has been a complete game changer in the energies. And grains are renewable annually, with even if Mother Nature causes some issues this year, Within 1 or 2 growing cycles, farmers can adjust their plantings and act accordingly and generally make up for a lot of damage done. So technology should keep rallies at least reasonable. So let's take a look at some of the headline grabbing commodities. A commodity market that I generally don't talk about is oats. Oats is a liquid. Not very many people use it as speculation. A lot of farmers use it for hedging, but it's not something that we pay attention to that often. However, in this particular instance, we're seeing oats trade close to $8 a bushel, an all-time high. And the oat market, ironically, seems to be leading the other commodities higher, or at least I should say the other grains. Corn and soybeans, not so much, but definitely wheat. One thing I wanted to point out, though, is commodities are boom and bust markets. Just when they look the best is when they're probably the worst. And this is a really good example of that. You can see in 2008 and 2014, and then again this year, there's a ridiculously sharp rally in in oats, but those rallies are they usually come just as fast as they go. And so you want to be really careful buying into the bull scenario in the grains. When you look at this chart, if wheat holds this resistance, which I think it probably will, oats. If oats holds this resistance, it will probably prevent the other grains from making much headway, at least until the spring. And this, by the way, this chart it's a little more exaggerated, but this is exactly what we tend to see in commodities because, like I said, high prices bring supply to the market. Another commodity that people like to pay attention to, but not very many people trade, is lumber. You might remember earlier in the year, lumber prices traded above $1,650 to $1,700, the highest we've ever seen lumber trade ever in history. My personal opinion this is a weekly chart, by the way. My personal opinion is that prices had no business getting up there, but in an economy that went from completely off to completely on, weird things happen. And you can see that the trend line was broken for 2.5, 3 weeks, but then prices quickly fell below the trend line and actually traded all the way back to where the rally began. Again, this is pretty normal for commodities. So you want to be really careful. If you're an investor trying to hedge your portfolio, you don't want to get into the mindset of I need to be long commodities and just let it ride, because that's just not how these markets work. They're boom and bust, feast or famine. And you also want to use this example in lumber as a reminder that when the media and the masses jump on board a certain idea, sometimes that's exactly when that idea is coming to a close. Just like I said, I think the reflation and inflation story is coming to an end. In the middle of 2021, everybody and their dog thought lumber was going to stay in the high 1500s or 1700 area, and it would put a damper on the entire economy. It would put everything to a halt. And we literally saw the exact opposite. Supply came, the lumber yards were moving, the sawmills were moving. They were working 24 hours a day because they knew that's when they could make their money. They could sell their lumber for much higher than they could ever in the history of lumber trade. And this is what you get. Supply comes, it always does. There are a lot of analysts that believe that we will see $100 oil. And I'm never going to say that it's impossible, because anything is possible in commodities and things change very quickly. This chart is probably hard for you to see, but hopefully you get the idea. There's a couple things in oil to keep in mind. This time of year, October, November, December, and even January are generally weak for oil. You usually see a top sometime in October, and occasionally you get some really big October sell-offs, and sometimes those sell-offs bleed into November and December. So it's possible we did see a top in oil in October. That seems in line with the norm. We haven't seen any real big selling. Anybody that's long might feel that way because we've dropped about $6, $7 from the highs, but in the overall scheme of things, that's literally a drop in the bucket. The last time crude oil is trading up in the $70 to $80 area. It fell to 40. So crude oil prices can literally cut themselves in half in a very short amount of time. And a lot of times it happens exactly when everybody is comfortable with the idea of higher oil prices. We've also noted that oil tends to have 3 waves up before it has a really big sell-off. And we've seen that in 2014, we saw it in 2018, we saw it in 2019, and we appear to be seeing that again on this particular move. So we'll see. The key line in the sand for us is we're looking at 2 numbers in oil, 77 and 72. If the market breaks below 77, that tells us the rally is probably over, or at least we've seen the we've seen the highs. I'm not saying that doesn't necessarily mean it's going to crash, but that means the sentiment has changed. Instead of buying dips, traders will probably switch to selling rallies. If we break 72, that's when it starts to get serious. 72 would probably lead to a quick move to 62. And then below 62, we start looking in the 40s. And I know this sounds crazy, but just imagine in March or July of 2020, if somebody told you we'd see $80 crude oil by 2021, most people would have thought that would have been impossible. So anything is possible at oil, especially $40 oil. We've seen it over and over and over again. So this is the same chart, but it's zoomed in just a little bit. I wanted to give you one more point of emphasis here. In 2010 to 2014, oil was comfortably in the high 80s or $100 barrel area. There was a band of support from 77 to 84. Anytime the market dipped below 84, buyers became active. Once it got into the high 70s, it was considered a screaming buy back then. And now we're in the exact opposite scenario. That band of support is now a band of resistance. So the way I'm looking at it is anything around the mid 80s is a place for the bears to consider getting aggressive. And anything below 77 should also be seen as a failure of that rally and possibly start looking for some follow through. Let's take a look at corn. Corn isn't necessarily the most popular commodity, but it's extremely liquid and it attracts a lot of hedging. Corn also is a good representation of how commodities move. You don't, again, I'm going to say this a million times, commodities are not an investment. You don't want to go long corn and hold it forever. You can see that corn has rallied this particular year from $3 to $8. But on previous occasions, we've seen that rally to $8 from $3 fizzle all the way back down to where it started, around $3. So there's a lot of chatter out there that this year is different, the fundamentals are there, so on and so forth. And I do think that there are supportive fundamentals for maybe the next crop year. So we're talking December 2022 corn. Sure, probably isn't going to get a whole lot of selling pressure, at least for now. But with that said, you want to be really, really careful being long the grains, just simply because complacency tends to kill. Anybody that was complacently long corn in previous rallies probably paid the price. So be really careful with that. So this is natural gas. Natural gas has gotten a lot of attention this year for obvious reasons. Natural gas, this is a weekly chart, by the way. We've seen natural gas rally in 2017, 2019, and now 2021. It's followed a trend line. And that trend line has held nicely on the previous occasions, and so far so good this year as well. And I do think that 650 to 675-ish will hold. That's, again, trend line resistance in nat gas, but it's been extremely volatile. And trend line support is coming in basically where the market officially broke out to the upside, and that's at about 450. So The expected trading range through the winter season is going to be from $4.50 to $6.50. It's a $2 range. That's a huge range. Most years, natural gas doesn't move $1 all year, let alone $2. And we've seen prices move on both sides of that range a couple of times in a matter of months. So we're seeing moves in a day or two in natural gas that generally don't happen in a year. So it's extremely volatile. It's not for the faint of heart. In fact, I'd say that most people are probably better off just sitting on the sidelines in this market. But with that said, there's a lot of talk of natural gas going to $10, $15. I really don't think that's going to happen. It's interesting though, because the option market is behaving as if maybe it's possible. There's a lot of interest in buying options with $10 strike prices, and people are paying thousands of dollars for them. But the reality is we haven't seen gas get above the $5-ish area since fracking has come along. And I know there's political pressures and things that have kind of put a damper on fracking, but the reality is the supply shortage is not, it's not something that can't be resolved if we don't start producing. We can produce, we just need to do it. So with that said, be careful in natural gas, regardless of which side you're playing. But the reality is, if you're one of those that are buying call options with strike prices of $10, $12, just understand it's a pure lottery ticket. And the odds of natural gas doubling from here are pretty slim. So the odds of making money aren't great. The other commodity that everybody tends to ask about is copper. Copper is obviously in an uptrend. And honestly, it's been holding the gains better than a lot of people would have expected, including myself. I thought at some point before now, we would have broken below $4 and started heading back down. There are some different things in copper now than we've seen in the past. For instance, the EV car revolution has definitely increased the demand for copper, but in the long run, copper has a really nasty habit of making new all-time highs and then almost crashing afterwards. So you want to be really, really careful with copper longs. That said, I do think we actually just sent a newsletter to our clients this morning about the prospects of copper over the next several weeks. And I actually do think copper holds the 420 area and rallies back up towards the $5 range, which is the top of this little trading range we're in. But even with that short-term prospect in mind, everybody should always keep in mind the big picture in copper, which is generally, again, a feast or famine market. And one thing to keep in mind with copper is if it starts to roll over, it has could be a good indication of everything else rolling over. When I say everything else, I'm talking about risk assets such as stocks. So if you start to see copper break below $4, it's probably a really good red flag to pay attention to in regards to lightening up risk in your stock portfolio. So in conclusion, inflation is the talk of the town, but consumers and producers truly are in control, at least partially. High prices change behavior. Producers bring more supply to the market to capitalize on windfall prices, and consumers can reject prices. I know that it's true that we have to eat and we have to get to work, but we can do things like taper consumption. We can travel less, we can put off projects. We can use alternatives. Maybe those are EV automobiles, maybe wheat-based livestock feed instead of corn, or vice versa. So inflation can be somewhat tapered by behaviors. And in the case of producer behavior, it can be dramatically tapered. Also, technology has created an environment of better informed consumers with more choices. And in my opinion, that works against sticky inflation. And when I say sticky, I'm saying several years, not several months. So a lot of people have come to the conclusion that this inflation isn't transitory. Maybe it is, maybe it isn't in the commodity world. So if we're talking about true commodity prices, grains, energies, I truly believe it is transitory. And I think we're at the beginning of the end of that story, but time will tell. Nobody has a crystal ball. I appreciate you coming out. If you have any questions, I have a few minutes here to answer, maybe 1 minute.
Yes, Carly, thank you so much for that presentation.
Sure.
There are a few questions here, so let's jump into it. We have time
Okay.
for maybe 2 or 3, okay?
Okay.
What is your opinion of Exxon versus Chevron?
So to be honest, I deal in the commodity itself, not the individual stock. So I can't really say much about that. But what I can say is the big shale producers have been really, really slow to bring supply to the market, which is the opposite of what we saw in 2014 and 2018. Usually the big boys have jumped on and brought supply when prices started to get high. But this time around, I think it's the small producers that are really kicking into gear. They've started, the last I checked, they were adding more rigs than the bigger producers. So I think it's the small producers that are really going to shine. Unfortunately for investors, those aren't they're not publicly traded companies, so it's a little harder to get involved in those.
Okay, thank you. Now, do you trade precious metals? And if so, what's your outlook on gold and silver?
Sure, we do. We follow precious metals very closely. We are of the opinion in the long run, I think gold and silver are probably going to shine, pardon the pun. And the reason being the other commodities have seen really substantial booms in 2021. Gold and silver were the underperformers, and I think they have to catch up. With that said, both gold and silver are approaching trend line resistance, and we're also at a time of year where gold and silver generally have a struggle. So I tend to think that we're probably going to see a little bit of a pullback for the next month or so, and then from there, I think we resume the rally.
All right. Now, what is, I guess, your outlook for forward months prospect for iron and coal?
That's a great question. To be 100% honest, those are markets that don't have viable futures contracts attached to them. So there's not a lot of speculation going on. So I truly don't have an informed opinion on those. So I'll plead the fifth.
Not a problem, Carly. Well, listen, we've run out of time, but I do want to end on this because someone is asking what is the name of your book?
Okay, so I've written multiple books. If you go to Amazon, you're going to see several. The only one that the only three you need to pay attention to is A Trader's First Book on Commodities, the 3rd edition, Trading Commodity Options with Creativity, and Higher Probability Commodity Higher Probability Commodity Trading. So the 3 newest. The others just ignore, they're outdated and out of print.
And finally, where can we meet you face to face next?
Absolutely. Please come to Las Vegas for the February Traders Expo. I think it's an Expo Money Show, if I'm correct. It's like a combination.
We've kind of unified the brands to be a Money Show and Traders Expo. Thank you for that, Carly.
Perfect. Yes. So come see us in late February. We'd love to see you face to face.